Your crypto gains just got wiped by $600, and the Fed hasn't even spoken yet. Stocks are ripping, so why is your Bitcoin red? Friday, July 31st, 2026. Like and subscribe for daily market updates. Today's agenda: the daily split, big tech vs crypto, the war premium, why gold is falling, the dollar strengthens, market snapshot. Up next, big tech vs crypto. Look at this screen and tell me what makes sense. The S&P 500 is up 0.07% to sit at 7,443 points. The Nasdaq added 25 cents on the dollar to hit 25,185. Yet Bitcoin just lost 3.5%, sitting right around $62,600. Ethereum followed suit, down over 3% too. This isn't a glitch in your app. This is a deliberate choice by traders who are scared of an August dip. But the reason this divergence feels so sharp today comes down to what's happening in oil and energy markets right now. For the record, WTI crude is higher on the day, up about 2%. For the record, WTI crude is higher on the day, up about 2%. Amazon surged 13% after analysts hailed its cloud infrastructure performance as definitive proof that hyperscale data centers can handle next-generation AI compute loads without latency. This validation reassured the entire sector, prompting Microsoft to jump 16%. Azure's metrics confirm it remains dominant for enterprise machine learning, despite fierce competition from Google and Meta. Apple beat revenue expectations, but shares slipped slightly as soft services growth failed to match explosive hardware demand seen previously, leaving profit-taking pressure near all-time highs. In stark contrast, cryptocurrency names struggled significantly today. Coinbase posted heavy losses driven by regulatory uncertainty and reduced trading volumes from institutional clients pausing allocations until clarity emerges on SEC enforcement actions. Similarly, MicroStrategy took a hit after its Bitcoin holdings faced valuation challenges as spot prices corrected following an aggressive futures sell-off that wiped out recent borrowed money. This divergence highlights a critical second-order effect. Traditional tech stocks benefit from predictable cash flows and massive government contracts related to national security computing, while crypto assets remain vulnerable to big-picture economic shifts and regulatory overhangs capable of triggering rapid deleveraging cycles reminiscent of 2018, when leveraged tokens collapsed overnight. Historically, this pattern repeats whenever the Federal Reserve signals tighter central bank policy. Capital rotates swiftly from high-beta speculative vehicles into defensive megacap technology stocks offering dividend yields or buybacks. For concrete investor implications, portfolio managers must distinguish between companies with tangible earnings power and those relying purely on token price appreciation, which offers no intrinsic value floor. The current market structure suggests only large-cap tech firms will sustain how expensive assets look relative to earnings as interest rates stabilize, while smaller crypto names face a prolonged consolidation period, where available cash in the market dries up quickly during any sign of economic slowdown or escalating global political tension. And that fear of higher inflation is exactly why gold, usually the safe place to store wealth, is taking a hit today as well. Brent crude futures trade just shy of $90 per barrel, but this stability is deceptive. It reflects a market digesting a massive global political shockwave rather than finding true equilibrium. The United States recently executed a decisive kinetic campaign against Iranian military assets, neutralizing the immediate regional threat, while keeping the Strait of Hormuz functionally closed or highly volatile. This choke point handles approximately 20% of global seaborne oil flows. Its closure triggers an instant supply shock mechanism that forces traders to price in potential rationing and rerouting costs, directly fueling persistent inflation fears across commodity-dependent economies. Historically, similar premiums spiked during the 1973 OPEC embargo or the Gulf War of 1990-1991, where physical threats caused oil prices to double within weeks, before stabilizing at a new baseline. Today's market attempts to replicate that pattern with modern financial derivatives, amplifying unpredictable price swings. Second-order effects are already visible in energy-intensive sectors like transportation and manufacturing, where input costs rise faster than consumer price indices can adjust. For investors holding long-duration assets or those sensitive to inflation, this environment demands recalibrating risk models, equity portfolios weighted toward utilities, and industrials face margin compression as raw material inputs climb. Conversely, the oil patch may see accelerated drilling if producers believe supply deficits are structural rather than temporary. The current $90 price point is a holding pattern, while strategists assess whether Iran's retaliatory capabilities have been permanently degraded or merely paused for negotiation. Until clarity emerges, capital will likely remain on standby in energy sectors, seeking yield to offset the elevated cost of carry associated with war risk premiums embedded in every barrel sold globally. That brings us to the dollar strengthens. Gold trading near $4,098 presents a puzzling anomaly within the current economic landscape, where real yields remain aggressively elevated. Historically, gold functions as a zero-yield asset struggling against rising interest rates. Investors typically rotate into bonds or savings accounts, offering tangible returns rather than holding unproductive metal. The mechanism driving this specific price action involves a complex tug-of-war between demand for safe wealth storage triggered by global political instability and the overwhelming mathematical drag of high borrowing costs on non-dividend paying assets. When central banks maintain steep rate differentials, the opportunity cost of holding gold spikes, forcing institutional allocators to trim positions despite fear premiums in other markets. This dynamic mirrors the 2013 taper tantrum, where a sudden shift in Fed policy expectations caused precious metals to bleed value rapidly, even as global uncertainty persisted. The second-order effect is significant for portfolio construction. If gold cannot sustain prices above $4,000 while Treasury yields hold firm at current levels, it signals that the market views central bank balance sheet expansion or currency debasement as insufficient hedges against inflation in this specific cycle. For concrete investor implications, relying on traditional safe place to store wealth narratives may be flawed. Capital must instead seek yield-bearing alternatives like tips or high-quality stocks until real rates normalize below zero to reignite gold's historical purchasing power advantage. The current price level suggests a fragile equilibrium where any further rate hikes could trigger a sharp correction, while unexpected pivots in favor of lower rates might cause an explosive rally that overshoots fundamental valuations entirely relative to earnings. Finally, let's review the past few days to see if our predictions were accurate or not before wrapping things up for you. The US dollar index rose 0.43% in early trading, settling at 100.29 as global risk investor mood cooled overnight. This appreciation stems from widening yield differentials between American treasuries and European sovereign debt. Investors now view the Federal Reserve's restrictive stance as more durable than expected. With 10-year yields near historic highs, capital flows into dollar assets to chase that premium, creating a cycle where higher rates attract foreign buying, while dampening demand for non-yielding currencies like the euro or yen. Historically, similar yield gaps pushed the greenback past parity against major peers in late 2015 and early 2018 before reversing once rate cuts arrived. However, current conditions differ because sticky inflation in services sectors suggests policymakers may keep rates elevated longer than previous cycles. For multinational corporations with significant overseas revenue, a stronger dollar acts as an immediate headwind by reducing the value of foreign earnings when converted home, potentially compressing quarterly profit margins across tech and industrial sectors alike. Conversely, emerging market borrowers face tighter refinancing conditions as local currencies depreciate against this strengthening benchmark, raising default risks that could spill over into global bond markets if not monitored closely. The second-order effect is a potential slowdown in cross-border trade volumes, which might eventually force central banks to reconsider raising interest rates paths sooner rather than later. Investors should recalibrate exposure to dollar-hedged positions and scrutinize balance sheets of companies with heavy international operations before making allocation decisions based solely on headline earnings reports that ignore currency translation impacts. Finally, let's turn to Market Snapshot. Here are the exact numbers from Yahoo Finance grounding us in reality right now, revealing a market under significant pressure as risk assets retreat on renewed big-picture economic uncertainty. Bitcoin trades at $62,597, having surrendered over $35 billion of its total valuation in just 24 hours. a drop of 3.5% signaling institutional hesitation rather than mere retail unpredictable price swings. This decline mirrors sharp corrections seen during the 2018 crypto winter and March 2020 available cash in the market crunches, where fear drove prices down regardless of underlying utility or adoption metrics. Ethereum sits at $1,857, also down over 3%. Its struggle carries distinct second-order implications for the broader decentralized finance ecosystem. As a smart contract platform, Ether's price is inextricably linked to network activity and gas fees. When prices fall this hard, developers often pause new launches, while investors liquidate positions to cover margin calls or rebalance portfolios away from high-beta alternatives. The mechanism driving these simultaneous drops usually traces back to a raising interest rates dollar index or rising treasury yields, which make non-yielding digital assets less attractive compared to risk-free government bonds. For the average investor holding directly in crypto, this represents an immediate paper loss that could erode retirement savings if held too long without diversification. However, for those using leveraged positions via futures or options, these moves can trigger automated liquidations, creating a feedback loop of selling pressure that amplifies the initial drop into a deeper crash. Historically, such synchronized dips in major cryptocurrencies often precede short-term bottoms, where panic selling exhausts itself, before smart money re-enters at better, how expensive assets look relative to earnings. The concrete implication here is clear. Do not chase lower prices out of fear or greed during these moments. Instead, assess whether your portfolio allocation to volatile assets remains appropriate given current interest rate environments and economic data releases. Today was a day of stark divergence in the markets, and that is something you need to understand before making moves on Friday afternoon. Bitcoin dropped 3.5%, while Amazon soared 13% after a cloud blowout. The war's inflation lingering pressure isn't going away either. Oil stayed high near $90 because the Strait of Hormuz remains closed. Thanks for watching Market Pulse Daily.